Hello everyone. Today I show you my stocks portfolio performance. I will tell you about the new stock that I added to the portfolio in the last month. I will tell you about my experiment with Wealthsimple Margin. I will quickly go over the earnings report of Louis Vuitton and why I believe the stock will eventually rebound to its previous all-time highs. I will also quickly go over Google's earnings report and discuss why the stock didn't experience any major upside move even after their amazing growth numbers. And we'll finally show you some new features of my portfolio tracker software and how you can sign up for pre-launch early access to this upcoming software. Maybe I can start with a little experiment that I started with Wealthsimple Margin feature. This is a relatively new feature of Wealthsimple where you can take out a loan at prime rate, which is now at 4.95% against your TFSA stocks portfolio. A couple of subscribers asked me to do a review of Wealthsimple Margin account, and I said to myself, why not? So I took out a $17,000 loan against my TFSA stocks and reinvest that money into my TFSA. I wanted to eventually do this by the end of the year anyway, so instead of depositing small amounts of money, I decided to take out this margin loan and try this new feature and hopefully review Wealthsimple Margin after I use this margin account for a couple of weeks. And I also use this as a bridge lump sum deposit until I can pay this margin loan back by the end of the year. The most important point here is that I have cash and assets outside Wealthsimple to cover all of this loan tomorrow. So I'm not making any risks here, and I absolutely do not suggest to use debt to invest. As I mentioned, this is just an experiment to see how Wealthsimple Margin accounts work in real life and how they charge interest and things like that. And of course, their interest rate is really low compared to any line of credit you can get from any bank at the moment. So I guess it's going to be a fun experiment. I will show you what I did with this money, but before that, let me start with a portfolio overview. The combined portfolio of our family, me and my wife, is worth close to 200,000 Canadian dollar today, but that is including the margin loan that I got from Wealthsimple, so the real portfolio value minus the margin is actually $182,000. And that is what I use to track the performance of the portfolio here. We are up 82% or 82,000 Canadian dollar from where we started investing in these portfolios, which is almost 3 years ago. We had this amazing performance by not taking on so much risk, which makes this number even more impressive. We do not invest in speculative assets and companies and obtain this performance by investing in undervalued solid businesses around the world. Companies like Meta, Google, Brookfield, Amazon, and less known solid businesses like EQ Bank. I personally have almost $126,000 in my Wealthsimple, which is up 66% or $50,000. And I also have this small $14,700 portfolio in National Bank Direct Brokerage. And we also have close to $44,000 in this smaller separate Wealthsimple portfolio, which has shown an impressive 316% return in just 3 years. As our wealth is combined, we manage all of our assets as a single combined portfolio, which I track them here. As you can see in this new website project that I'm working on for a couple of months now. Pretty much everything is automated in this new software, and I added new features and insights which makes tracking of positions so much easier. Let's look at overall portfolio allocation. This is a nice graphical representation of the stocks we hold in our combined portfolio. This is overall a concentrated portfolio with only 11 different companies. The largest holding in this portfolio are these 3 companies. My winner's triangle, Brookfield Corporation, Meta, and Google with 15% weighting each, followed by EQ Bank with 12% weighting, then Alimentation Couche-Tard with almost 9% weighting, Louis Vuitton Constellation Software, which is the new addition to portfolio, and Amazon with almost 7% weighting, Novo Nordisk with 6%, Aritzia with 3%, and finally a tiny intact financial position with only 2% weighting. The portfolio is pretty concentrated, as you can see, which shows how much I believe in these companies. If the share price is right, the plan is to build a larger stake in Intact Financial so we can have a much more balanced portfolio at the end. Okay, next the software will show me the geographical allocation. As you can see, 51% of our assets are in Canadian companies, 36% in US companies, 13% are in European companies, so no exposure to China or other markets at the moment. We have almost equal weighting in terms of US dollar and Canadian dollar in these investments. So almost half of our investments are in Canadian dollar. The other half is in US dollar, which is the balance that I like. In terms of sector allocation, tech stocks are 43% of the portfolio, which may be a little bit too much, but most of that came from capital gain from tech stocks. Then we have financials at 30% weighting, which is again a little bit too much. And then we have consumer staples, consumer discretionary, and healthcare stocks. So a relatively nice diversification in terms of other sectors. Finally, we can look at the best and worst performers in my portfolio here. According to the software, Meta is my top performing stock, which is up 370%, followed by Aritzia with 96%, Amazon with 84% performance, Brookfield Corporation with 78%, EQ Bank with 63%, and then Google with 56% performance. These are all amazing performances by my top 6 stocks. In terms of the worst performers, we have Louis Vuitton Moet Hennessy, which is definitely the worst performing stock of mine with minus 11% weighting, but it is closing the gap. It was down over 20% last month and now it is sitting at minus 10%. So the stock has a nice momentum at the moment. Speaking about momentum, I want to know why Alimentation Couche-Tard or Louis Vuitton had a nice positive momentum in the last month. So I can click on this new feature of the software, which is called Intelligent Query Momentum Analysis. The software will gather my portfolio data, including my stock ticker symbols, their weighting, their sectors, and everything that I showed you here, and then write an intelligent query to Google Gemini Pro API, and we'll get the results back and print it on your screen. Perfect. So finally, we can see this AI-generated report. This is AI momentum analysis, last month performance of your stocks. So this is the report that is generated by Gemini Pro API. So based on the report, Louis Vuitton or LVMUY had the best momentum in the last month between my stocks. It was up 10.35%. So here is why. LVMH recent earnings report, while showing year-over-year declines in revenue and profit, exceeded lowered investor expectations. The market reacted positively, potentially viewing the results as a sign the stock had reached its bottom after a significant fall from its peak. So recent news highlights the stock surge despite these declines, suggesting a market belief in potential recovery. So this is the reason why LVMUY is up 10% in the last month. Next, we have Brookfield Corporation. It is up almost 10% again. So let's see what AI thinks about Brookfield. Brookfield Corporation's strong performance could be attributed to its position in the alternative asset management sector, which may be benefiting from the current market conditions. The company's recent announcement of a renewed normal course issuer bid to repurchase shares also signals confidence in its future prospects and may have contributed to this positive momentum. And this is pretty accurate as well. Next, we have Alimentation Couche-Tard. Alimentation Couche-Tard's strong momentum is likely due to a combination of factors, including its strong year-to-date and past-year performance, and the recent announcement of a significant share repurchase program, demonstrating the commitment to the shareholder returns. The company also received FTC clearance for a key acquisition. Then we have Google. Google parent company Alphabet reported stronger than expected Q2 earnings, exceeded analyst estimations for both EPS and revenue. The robust growth across various segments, including Google Search, YouTube Ads, and Google Cloud, fueled investor confidence. While an increased capital expenditure projection initially caused some concern, the market ultimately viewed it as a positive sign of investment in growth areas like AI. So this is, as you can see, is a pretty accurate report generated by AI about the momentum of your stocks while your stock is up or down in the last month. For example, we can see the underperformers or stocks that had negative momentum like Meta, Intact, and Constellation Software. The software will also provide you with some reasons why these stocks are not doing as well. And also it gives you some overall market context. Okay, and some suggestions and actionable insights for your portfolio. So yeah, this is a new feature that I really like about this stock portfolio tracker. This software is called RRSP and has not only this portfolio tracker, it also has a DCF calculator I use to analyze stocks. It has legendary investor tracker with a nice graphical chart for each investor, and it also has a stock fundamental analysis tool with AI assisted insights, which all will be available for early access in the next couple of weeks. If you're interested, you can just go to yaraiq.com and sign up to receive an email from me when the software is ready for early access and secure a 20% discount for the first year. You just need your name and your email address at this stage. Sign up and I'm 100% sure you will like the software. In terms of individual account performance, let's look at my personal RRSP account first. My Wealthsimple RRSP consists of only stocks that are traded on US stock exchanges, and it is up almost 78% so far in the last 3 years. The portfolio had an amazing performance, and right now there are only 3 stocks in this portfolio, and I didn't change anything in the last month. Here I have 36 shares of Amazon, which is up 76% so far. Amazon by far was my best performing stock in this portfolio, and I started to add the stock in January 2023, which was probably one of the best times to buy Amazon. The future of Amazon is bright, and they have a lot of different avenues to reinvest their cash flow and grow even more in the future. I think Amazon here is fairly valued, so it's not expensive, but it's not a deal either. For me personally, Amazon is a solid hold at this point. I also have 100 shares of Google, which is up 58% so far. I think Google is offered one of the best risk-reward profiles in the market right now, and I have no issues adding to Google here. I think the downside risk is extremely limited with Google, and the stock has a nice upside potential as well. They recently have their earnings report, and pretty much everything was growing double digits with Google. Consolidated revenues in Q2 2025 increased 14% year over year. Google services revenues increased 12%. This includes their main search business, which a lot of analysts believed it is dead, and their YouTube, which both of them are growing double digits. This is amazing. Their cloud business is accelerating its growth at 32% year over year. They beat on their earnings and revenue estimates, and they mentioned they have so much demand for AI and cloud resources that they have yet again to increase their capex and invest in more data centers. And basically everything on this report was great, but the stock was barely up after this report. You may ask why, and my response to that is that until the Department of Justice case with Google Chrome is not settled, the stock may still trade at a range here. I think once the uncertainty of DOJ case is resolved, then Google stock can get what it deserves to get after these stellar numbers. The stock, in my opinion, is undervalued here, and I think this is one of those cases that the market significantly mispriced Google based on uncertainty around the future of one of their businesses. I will personally hold all of my Google shares here, and if we see any meaningful dip, I will buy even more shares. Finally, I own 120 shares of Novo Nordisk, which is up 3%. Novo Nordisk fundamentals are strong, but there are 2 overhanging major concerns for this stock, which resulted in this massive downturn for the company. Number 1 is the narrative that they are losing the competition to Eli Lilly in GLP-1 markets. Eli Lilly had drugs with better performance, and they are ahead in research and development in some of these drugs. For example, Mounjaro for diabetes and Zepbound for weight loss have shown superior weight loss efficiency in head-to-head trials compared to Novo Nordisk drugs. But the main point that some analysts are missing, in my opinion, is that the whole GLP-1 market is expanding rapidly, and Novo Nordisk and Eli Lilly can both grow at the same time. It's not Novo Nordisk or Eli Lilly. Both of them, in my opinion, can be winners and share the market as a duopoly. While Eli Lilly might gain a larger share in specific areas due to efficiency and innovation, Novo Nordisk has significant first mover advantage and established brand recognition and a strong existing market presence with Ozempic and Wegovy. Novo Nordisk is also actively working on its next generation of drugs like CagriSema and an oral version of Wegovy to basically stay competitive. The second major concerns for investing in Novo Nordisk is regulatory concerns and tariffs. This is something that's cannot be basically predicted, but I think US tariffs are mostly being used as a tool for negotiations, so I'm personally not worried about these concerns in the long term. Novo Nordisk is also already exploring options like increasing their US manufacturing to basically mitigate these potential tariff impacts. I will hold my Novo Nordisk shares here and will reevaluate the situation in the future, potentially after the next earnings report of the company. Okay, now let's move to my next positions. Outside of Wealthsimple, in National Bank Direct Brokerage RRSP, I own 93 shares of LVMUY or Louis Vuitton. They recently had their earnings reports, and overall, it was not a great report in terms of the numbers. And basically, they showed a continued slowdown in the global luxury sector. The revenue was down 4% year over year and down 3% based on organic numbers. Their profit from recurring revenue was down 15% year over year. These are not good numbers. On the positive side, Sephora still achieved double-digit revenue growth and they are gaining market share. The company operating margin is still strong at 22% and their free cash flow increased to 4 billion euros, indicating strong cash generation for the company. Despite the decline in overall revenue and profits, Louis Vuitton stock rallied after the earnings report. This seems to be counterintuitive, but in my opinion, it is mostly because the results were better than the feared results. It's better than expected. The luxury sector has been facing significant headwinds, particularly from a slowdown in China and consumer cautiousness in other key markets like United States. Investors may have anticipated even worse results, in my opinion, and the reported declines, while not ideal, they were perhaps better than what most of an analyst anticipated for the company. It basically signals a bottom to some investors. In my opinion, LVMUY has a very good chance of continue this upward trend and eventually after a couple of good earnings report goes back to its previous all-time high share price. I believe the long-term thesis for luxury remains strong, and Louis Vuitton together with Hermes, they are at forefront of luxury products. They have brand recognition, they have a management team that have significant skin in the game, and I think the worst might be over for Louis Vuitton with some hopes in the China number in this report. Overall, I will buy a couple of more shares of LVMUY if the share price remains at these ranges, and I will hold all of my shares at least until the next earnings report of the company. Okay, now let's look at my personal TFSA account. This portfolio only consists of Canadian stocks. Its value is close to $93,000 and it is up 44%. The reason it is up only 44% is that I deposited a large amount of cash, almost $17,000 recently from my margin account, which caused the performance number to go down. Anyway, let's go over each of my positions one by one. Let's start with Alimentation Couche-Tard. I own 250 shares of this company, which is now up around 2%. They recently announced that they will walk away from 7&I deal and they will continue to their share buyback program, and the stock had a nice little jump from $67 to $74. And I believe the stock will continue to perform well in the coming months. My plan with Alimentation Couche-Tard is to just hold my shares at the moment. Next, I have 330 shares of Brookfield Corporation. I'm up 78% on this position. The stock is continued to do very well and it just hit a new all-time high share price recently. This is one of my biggest bets and I think Brookfield will continue to outperform the market in the coming years. I will hold all of my Brookfield shares and will look into buying even more shares if the opportunity represents itself again. Next, we have the new addition to my stocks portfolio, Constellation Software. Constellation Software is a fascinating and highly successful Canadian software company that operates with a unique and effective business model. Their business model is based on serial acquisition of small vertical software businesses. I followed the company for some time and was really blown away by management team at Constellation Software, and well, finally I bought my first 3 shares of Constellation in my TFSA. Constellation has a buy and build approach and they have a strong track record of disciplined capital allocation and using the generated cash flow to fund new acquisitions and create shareholder value in the long term. I will talk about Constellation Software more in an upcoming stock deep dive analysis video, but for now, I'm happy to finally be a Constellation Software shareholder. Next, I have 235 shares of EQ Bank, which is up close to 63% now. I'm totally happy with my weighting and position size in this great company. I believe this company can still grow and outperform other major banks in Canada and basically take more market share in the coming years. My plan with EQ Bank inside my TFSA is to just hold the stock and enjoy the growing dividend of the company. The last stock that I own here, which is relatively new addition to the portfolio, is Intact Financial. I bought 12 more shares of Intact Financial recently, and now I have 17 shares. It is basically flat at the moment, and I will continue to buy Intact Financial at these levels to increase my stake in the company. There you are, guys. I hope you enjoyed the video. I will come back with a few more stock analysis videos soon, but until that time, I see you guys in the next video. Farewell.